Oil, that's your primary business. Let's talk a little bit about it. So after the Fed did that hawkish pause, we saw some downside moves in the oil market. It's kind of come back up, WTI back above $70 a barrel. How influential is the Fed in this whole story, and how influential is the Central Bank of China with its easing in the oil story?
You know, I think that our job as long-term investors in the sector is to look through the volatility. And what we're mostly focused on is the last 13 years of underinvestment. And I think there are two critical things about oil right now. So in terms of demand, in the U.S. and Europe, we are embedded in what's happening, taking down carbon footprint. So we have 2 billion people in the U.S., Europe, UK, Australia, Canada, working fastidiously to take down our carbon footprints. But that is a parochial perspective, because when we look at the world, we have over 6 billion people that are taking up their carbon footprint. And over the past 20 years, what that's resulted in is 20 million barrels a day of incremental demand, which took us from 80 million barrels a day of oil demand as a world to 100 million barrels a day. So that's one of the fundamental issues with why supply is so resilient, and also why oil and gas continues to be something like 56 to 60% of global fuel share. So we have very resilient demand. And the other thing, and this is a bit of geology early for the morning, but when you look at petroleum reservoir engineering and geology, this is an asset that declines.
Right.
And the global base decline for oil is 5%. So we lose 5 million barrels of production as a world every year. And importantly, because shale has different reservoir characteristics, we have a 30% base decline, so we lose 30% of U.S. production every year. And when you have a depreciating asset that's investing below the rate of depreciation against resilient demand, you have a supply issue that will be bullish over the next 10 years.
All right, you took us a little bit in the weeds, but we get it. There's going to be more demand, maybe for longer than a lot of people believe. I want to go back to the Fed, possibly 2 more hikes later this year. How does that impact your willingness to spend CapEx, to drill into more wells? Does it impact it at all? And has the break even when it comes to oil, has that story changed?
So oil prices this year have averaged about $70 a barrel, which is pretty stable, and that gives us a good outlook to invest off of. But also, public companies are generally hedged over 30% for oil production. We're hedged over 90%. And if you look at the oil and gas sector overall, if we were talking about 2015, it would be a much more levered sector with a lot more debt that was levered both at the balance sheet level and at the commodity level. So commodity price volatility would have a bigger impact. Because the energy sector has taken debt down to 0 to 1 times debt to EBITDA today, almost no debt in this sector, we don't have that balance sheet leverage, so people can invest through the cycle. Plus, $70 oil is pretty attractive. Now, that being said, the sector experienced very high oil field service cost inflation last year. So, you know, in some basins, I would say like a $70 oil price is the new $50 oil price, just because the base cost that you need to invest has risen. However, with that 70% plus decline in natural gas prices since Thanksgiving, we are seeing the natural gas producers take down rig count, which is leading to a little bit of softening of oil field service inflation.
We're almost out of time. I want to ask you, when do we reach peak oil? You have so much insight into the oil industry. A lot of people, we were talking about EVs actually in this show for quite a bit. What are the factors that are going to get us to peak oil, and when we see oil reach its peak and then possibly its demand and everything else decline?
So probably we see peak supply in 2028. That's what we're seeing based on U.S. production. And the U.S. is only 12% of global oil supply, but it is the only jurisdiction for the past 10 years that's been able to grow oil supply. So as the U.S. goes, so goes global supply and pricing. So it does really matter. And the other thing I would say is that, you know, the energy transition is obviously very metals intensive. And that requires metals like copper, manganese, nickel, cobalt, lithium, tin, graphite. And when we look at the other side of the natural resources sector, we see similar disinvestment over the past 13 years. So when we look at global mining CapEx, you know, it's down 50% since 2012. Global oil and gas CapEx is down 60% since 2012.